Whenever global conflicts start making headlines, it really sends ripples through the financial markets, doesn't it? For investors, all that uncertainty can be a little nerve-wracking, but it can also open up some interesting opportunities. So today, we're going to dig into whether it's actually the right time to start looking at defense and commodities funds. Let's dive in. And that really is the big question, isn't it? When the markets get choppy and things feel uncertain, do you just hold on tight and stick with your long-term plan? Or do you try to catch what could be the next big wave? Let's break down those options. Well, it really boils down to two main ways of thinking. You've got the classic advice, right? Which is to stay the course, trust the diversified portfolio you've already built. But then there's that temptation to chase the opportunity, to pivot into sectors that are actually booming because of the crisis. And honestly, this is where a lot of investors can get a little stuck. So let's talk about that second option. Let's explore the appeal of chasing those crisis-driven returns. I mean, what's really behind this sudden surge of interest in these specific sectors? It's a pretty fascinating dynamic when you think about it. Geopolitical tensions can create this sort of perfect storm for certain industries. And lately, two sectors have really been in the spotlight. Commodities, we're talking funds that invest in raw materials like oil and gold, and defense, which covers companies that supply military and security equipment. And wow, the numbers, they really speak for themselves. In just the past year, commodity funds have seen returns of around 83%. Meanwhile, defense funds have gained about 47%. I mean, those are just staggering figures that are pretty hard to ignore. And just to put a pin in it, the top-performing commodity fund, the Quantum Gold Savings Fund, delivered an absolutely incredible 85.26% return in the last year. So it's really no wonder these funds are getting so much attention. And the defense sector? It's seen some really impressive growth too. The Motilal Oswal Nifty India Defense Index Fund, for example, posted returns of over 47%. So what in the world is fueling these massive surges? Let's take a closer look. All right, now let's peel back the layers on these two types of funds, because even though they're both getting a ton of buzz right now, they're actually driven by very, very different factors. So here's the key difference you need to know. Commodity funds are really tied to those big, broad economic factors. Think inflation, think supply chains. Defense funds, on the other hand, are much more directly linked to things like government policy and global security. Okay, so let's start with commodities. Their prices can absolutely spike because of inflation, major disruptions in global supply chains, or just simple supply and demand getting out of whack. All these factors can create scarcity and drive up prices, and that, in turn, is what fuels the returns of these funds. And this is exactly what experts like Akshat Garg from Choice Wealth point out. The performance is really conditional. So when all the economic winds are blowing in their favor, these funds can just soar. But when demand weakens, those amazing returns can vanish just as quickly as they appeared. Now let's switch gears and look at defense. The drivers here are a totally different story. Performance is often tied to huge long-term government contracts, national policy pushes for domestic manufacturing, what's called indigenization, and of course, heightened geopolitical tensions, which lead to bigger military budgets. Samir Mathur from Roynet Solution really hits the nail on the head here. These funds thrive on government spending, but it's so important to remember that if that spending slows down, or if global tensions happen to ease, the momentum behind these funds can fade too. So, we've seen the incredible upside, right? But, and this is a big but, with high returns almost always comes high risk. And that brings us to the really crucial issue of volatility. I mean, it's pretty much one of the fundamental rules of investing. The potential for these huge, outsized gains almost always comes with the risk of some pretty significant swings, both up and down. These are definitely not a smooth, steady ride. And this is exactly why it's so critical to understand that both of these fund types are what we call cyclical. Their performance comes in waves. A fantastic year can easily be followed by a period where returns are flat or even negative. They just don't offer that predictable, consistent growth year after year. So, knowing all of this, how should a smart investor actually think about these opportunities? Well, let's turn to the expert's playbook for a clear strategy on how to approach this kind of thematic investing. The prevailing wisdom is to use what's called a core and satellite strategy. Okay, so think of your portfolio like a solar system. The vast majority of your money, your core, that's the sun. It's stable, it's diversified, it's built for the long term. Then you can use a very small portion of your portfolio for these satellites. Those are the tactical, higher risk plays like defense or commodity funds that kind of orbit around that stable core. Akshat Garg reinforces this idea perfectly. Think of your portfolio like you're building a house. The foundation, the thing that holds everything up, should be built with broad, diversified funds. These thematic funds, they're like the decorations. Sure, they can add some flair, but they're not what you build your house on. So what does this all mean for you? Well, here's a simple checklist to run through. First, what are your goals? Are you chasing a quick gain or are you building long-term wealth? Second, be really honest with yourself about your risk tolerance. Can your stomach truly handle those sharp ups and downs? And finally, always keep a long-term perspective. Don't let today's scary headlines derail a solid plan that's meant to last for decades. So, after all of that, what's the one key takeaway you should walk away with? This is it, right here. Thematic funds, like the ones focused on defense and commodities, are specialized tools. They can be really effective for capturing specific opportunities, but they should never, ever be mistaken for the foundation that you build your entire financial future on. And that really brings us to our final question, and it's one for you to think about. Take a good, hard look at your own portfolio. Is it truly built for the long haul, or is it just swaying with every new headline? It's a question worth asking yourself.